Good day, everyone. My name is Ronaldo Maranzan, and I'll be discussing the roles of sound financing, working capital management, financial record and reports, financial record keeping, and the books of accounts. So, first is let's talk all about the roles of sound financing. Borrowing, you must be careful to overlook structure of your business. That is why roles of sound financing. So when you say sound finance role, is the response to a fault. Sound financing involved a set of roles that always balance the budget except in a wartime. In sound financing, it is ideally to have 40-60 equity ratio. So 40-60, which mean that only 40% you will be debt and the other remaining 60% equity must be finance your business. So let's say for example, if you need 100,000 peso to set up your business or to build your business, then only 40%, which is 40,000, must be borrowed. And the rest of 60%, which is the 60,000 peso, must come from your own contribution or equity. So this 40-60 ratio is recommended in order to provide for future structured when the business will be expanded, and also there is may changing circumstances and situations. So in addition to debt or equity requirements, you must comply the following rules. So the first one is fixed asset and working capital requirements. So you must be or during normal operation must be financed from the owner equity and the long-term loans or long-term liabilities, while the short-term requirements must be funded from the sources that offer short-term loans. So in short, the short-term capital requirements must be financed by short-term loans or like for example kaning mga lending, kanang pautang nga pag-ibig like that, kanang nakay-utang nga dapat you must be paid within 1 year 2 months or 1 year less, while the long-term loans must be financed long-term capital requirements. Kanang example sa long-term loans like kanang kanang car loans, home loans like that. You must be paid within 3 to 10 years. So next kay working capital management. Working capital management, it is essentially an accounting strategy with a focus on the maintenance of sufficient balance between the company's current asset and liabilities. So when you say working capital management, it is a business tool that help companies effectively make us of current asset and maintain the sufficient cash flow to meet short-term obligation or goals. So working capital is concerned with the day-to-day financial operation of a business and the problem of ensuring that there is enough cash in the firm to be able to pay what is owned and still to continue to trade. So, how does working capital work? A firm buys a quantity of goods that is intended to sell later on at a profit. It cash flows, but it has stock in hand. The goods are subsequently sold on credit terms at a profit. Purchases are made, but the firm may not pay for those purchased immediately. It may hold on onto the invoices, especially if there is or if it is a little short of cash. Eventually, the customer pay up, and the firm can use the cash to pay what it owns and be able to buy even more goods. So why is there a problem? The firm may not be able to get its hands on enough cash when the supplier asks for payment, which in the higher stock level including work in progress, low profit margin, and a fast rate of sales growth often compound the problem. Therefore, if you wish to buy more stock, your cash goes down. If your customer do not pay, your balance fall. Or the other code is what it calls this kanang your overdraft rises like that. So in accounting equity will be used stock plus debtors plus cash is equals creditors plus borrowing plus capital or equality capital. So next kay financial record and report. Some of business failed because the owner or the business person or the manager was unable to keep track of how business performed. So financial record and report are formal records of the financial activities and position of a business person or other entity. A profit and loss statement provide information on the operation of the enterprise. This includes sales and the various expenses during the stated period. They may fail to notice the following. The first one is heavy operating expenses, inadequate sales volume, high level of receivable, excessive inventories, and the last one is excessive fixed assets. So these failures could have been avoided if the owner keep an adequate financial record keeping. But also, in analyzing this document for management and control the purposes. So in managing of an enterprise, you need to have sound and timely decision and the fund allocation of the different operating units and the sources from which is the funds would be taken. To be effective, your decision must be based on reliable and up-to-date information. To do this, you as an entrepreneur need to maintain a record of all transactions the enterprise has made. These transactions represent your enterprise operation and effect in financial status. So next kay financial record keeping. So financial record keeping is the cornerstone of the healthy business. So the recording of transaction within the business is referred to as bookkeeping. The record are called book of accounts. The effect of transaction are drawn out from the book of accounts and summarized into or in a report called as profit and loss statement or income statement. The resulting of the financial status of the firm is also drawn out from the book and reflected in a report. That is called the balance of sheets. So accounting is the whole system of recording and interpreting the result of a business transaction. That is called accounting. So the flow of recording business transaction is as follows. So the first one is transaction occur daily, proper supporting document are prepared, debt and creditors are recorded in the journal, summary total are posted on the ledger, and the last one is preparation of the balance sheets and income statement. In the features in the features of good accounting system are as follows the simply to understand. You must be flexible and adaptable to changing needs, inexpensive to operate, little time to operate, and handy and convenient to use. So the system is referred to as accountancy system and the output of accounting report and records. So the next one kay book of accounts. So book of accounts are record that reflect the day-to-day business transaction of all corporation, partnerships are representative in BRI, are required to pay taxes. So, book of accounts that take place where all financial information of a person or business is collected or is collected. So, an enterprise would need the following book of accounts. So, the first one is journal. So, the journal is the chronological record of the business transactions or the business transaction of the enterprise. It also referred to as the book of original entry. The entry show the effect of transaction of the different item in the business sheets. So when you say general journal, also called the say also called the book of original entry, because it is the first book where the business transaction are recorded. Journalizing is the business. The business is the process of recording in the journal. So entries in the journal or the general journal must be supported by evidence or document such as sales invoices, supplier invoices, official receipts, and purchase order. Furthermore, there are basic type of journal that can be kept such as kaning purchase journal. So purchase journal, this book of accounts, you use to record all purchases and disbursement, including purchase of merchandise on account. And the second one is sales journal. Sales journals, this book of accounts, you use to record all sales, including sales of merchandise on accounts. And the third one is cash disbursement. So this book of account you use to record all cash paid by the business. And the last one is the cash receipts. So this book of accounts you use to record all cash received by the business. So next kay general ledger. So general ledger, also called the book of final entry. So in this book of account, you can see the ending balance of each account you record in general journal. So posting is the process of recording in the general ledger. So general ledger is a collection of account as usually bound, showing the different transaction of affecting the item in the balance sheets. So the general ledger provides a summary of all the changes that affect each particular account. So after all business transactions for the day have been recorded in the general ledger. So the next step in the bookkeeping cycle requires that all entries be properly transferred to the general ledger. So the journal entries become useful once they are classified and summarized accordingly through the general ledger. You are able to classify and summarize all your business transactions and see at a glance how they affect your business of accounts or your business accounts. So those all my report. I'll give the floor to the next reporter. Thank you.